Ready to go?
Ready, ready.
Excellent. Welcome, everybody, to the quarterly update from Vision Based Planning. My name is Jay Coulter. This session will feature Chris Rawson and Brian Bly, but I also want to make sure everybody knows some of our other team members, Penny Jones and Camden Elliott. We're going to walk through some prepared remarks and slides. If you have questions, please ask them in the chat. When we get to the end of the presentation, I'll pose them to the team. So, with that, why don't we go ahead and start.
Good. All right.
All right.
And my internet is slow, so I apologize. There you go.
No worries at all. So, why do we host this event at Vision Based Planning? We do it because we care about you. Our focus is to guide our clients to feel confident in their long term financial plan and to highlight factual, positive, and negative data points about the global economy. Today, the team is going to cover the US economy. What's the good? What's the bad? Then we're going to pivot to the international markets where the team will again go over the framework of what looks good and what looks bad. A pivot to your fixed income allocations today. We're going to talk about the fixed income markets in terms of good and bad. And then a discussion on how we're applying this on your behalf. And Chris will go through his popular food for thought section. And at the end, we'll have those questions. So as we go through this, if you have questions, please throw them in the chat and I'll make sure we ask them to the team at the end of the presentation. So I think we're going to get kicked off with the U.S. economy and what is going well. Brian, what are your
Thank you,
thoughts?
Jay. Thank you, Jay. So first off here, as far as the good, um, S&P 500 companies, profit margins remain good. So any impacts of tariffs or general economic activities not being seen thus far within U.S. profit margins. It's ticked up a little bit since last time we met, and it's now sitting at 13.6 percent. So once again, it's above pre-COVID and really close to where we got peaked at a high a couple years ago at 14%. So moving on, another positive place. So we've seen this slide several sessions. One difference is if you note here to the left, currently there's about 7.4 million people looking for work. As far as job openings, there's just over 7.2 million. So this is the first time in a number of quarters where actually the number of job openings was lower than the number of people looking for work. But regardless, the labor situation is looking good. Any slowing of the job growth is anticipated to be suppressed by either flat or declining labor force, and that which will keep our unemployment rate holding steady. And partially some of that's due to the immigration decline. Right now it's not on this chart, but right now our unemployment's around 4.3%, and wage growth still remains steady. It's about 3.9%. Here's our economic growth in GDP. Looking at the second quarter figures, the last available, it's still actually above the trend line. For second quarter, it's at 3.8%. So still looking good as far as gross domestic product is concerned. One of the things that's anticipated that potentially, some tariffs and related uncertainties, as well as federal government setbacks, may slow the economy a little bit going into the fourth quarter. But looking forward into 2026, the One Big Beautiful Bill Act, or OBBA, it's expected to maybe possibly inject a little bit of stimulus into the economy in early 26 via the tax refunds that folks will be seeing as part of the results of that act. So with that being said, we'll turn it over to Chris to look at some of the bad.
So where we start within this, there's a combination of what are the existing jobs available that Brian covered, which is the 7.4 million or 7.2 million. And then the next question is, how many new jobs are being contributed to the pool of existing job openings. And that's definitely a concern. You see this gray line in the general trend down. And this data is not necessarily due to the government shutdown. It's just a general concern that I'll say new jobs are are slowing down. So this is something that we're keeping an eye on, and this is very much part of the reason we host this event. So in terms of the next component is inflation. If you draw your eye to the far right and the diamonds, you see inflation for August of this year is 2.9%, and you see the trend of the diamond moving up and to the right. And so the inflation is a concern, and the trend of inflation just ticking up, it is just something that we're also aware of. If you see the orange section there and you draw your eye just above, you see it says core goods. This is a little bit of the tariffs starting to take hold and some of those prices starting to rise within core goods, because that's the majority of where we see the tariff price increases. And we have a couple of slides that we'll cover as we work through. The final component of concern for us to be aware of is what's called the PE ratio of the S&P 500. So let me unpack that and break it down. If you draw your eye to the left side of the screen, you have price. So the price of the S&P 500 as of September 30th was 6,688. So that's the price in the numerator. You have the earnings of the largest 500 companies in the denominator. So that number is $293. So when you divide the price by the earnings, you get this number. Right below you see 22.8. So if you draw your eye now to the top right and you see the PE ratio of 22.8, it's above the trend line. So what that means is that the price, the excitement of our growing economy is higher than the earnings. So Brian covered the profit margin. So we're going to be following what level of earnings are companies bringing in? What type of revenue? Is it not, we want to make sure it's not just excitement, but there's actually profit and earnings coming out of that. So where we are right now is we have the excitement. We've seen lots of growth within portfolios. So you're seeing the prices higher, and we're going to be looking for those earnings to grow as a result as well. So let me turn it over to Jay, and he'll give us the recap.
Yeah, so looking at the US economy today, there's a lot going on. As the team talked about, on the great side of things, US businesses have high profit margins. The existing job openings remain above 7 million. And real gross domestic product, also known as GDP, is averaging over 2% annually. These are all positives for investors. On the negative side, what we're paying attention to today are new job openings have a concerning trend here recently. Inflation continues to remain a bit of a concern. We're keeping our eye on it, and the S&P price compared to earnings is a little bit inflated. With that, why don't we turn our attention to the international markets? Brian, do you want to start with the good?
Sure. Thank you, Jay. Oh, so on the international standpoint, look here, a chart through the last 50 years or so. The areas that are shaded in gray are cases where the US dollar has been declining relative to other currencies. So you'll see that in those shaded gray areas, and then where the purple graph is, that's the international outperformance relative to the US. So we're once again in a period of declining dollar. And so it's anticipated, while the international has not quite outperformed the US, it's trending towards that point. And that was one of the reasons why we made this shift last quarter, to make sure we tick up the international exposure a tad bit relative to the US. We've seen this chart before. If you take a look at the light or the medium blue, that's the Eurozone. The Eurozone unemployment rate still remains in check. It's actually ticked down a little bit since we last met. And then the same really goes for the Japan unemployment rate in light blue. It is remaining steady around 2.5, and it's actually declined just a tad bit as well. So from a developed international market perspective, looking at the Eurozone as a whole in Japan, unemployment once again remains in check. There's no concerns on the labor market in those areas. Looking at the inflation front, bringing your highlight first, the chart to the left is when we last met. It reflects the inflation index for international companies as of the end of May. And the chart on the right is the same index at the end of August. Two things we've highlighted, two countries we've highlighted, or two areas we've highlighted here from a developed market standpoint is in the light blue, Japan. Looked at since we last met 3 months ago. Japan, their inflation, their CPI has decreased by 0.4% from 3.5 to 3.1. And then the Eurozone remains about steady. It ticked up a little bit, but basically inflation remains in check for the major international areas outside, and this is of course outside of the US. And of course in there, it's got some individual countries and some emerging market countries too. But just wanted to highlight the two developed market areas. From a central bank standpoint, to bring your eye to the red line, that's the Bank of England. They last made a cut on August 7th, and they held steady in the 18th, in September 18th. And then likewise, the ECB, or the European Central Bank, which is in the medium blue, they made 2 rate cuts this year, but the last one was back in June. About 4 months, or just over 4 months ago, was the last time they made a cut. So unlike what we'll see this here a little bit later, unlike what's going in the US, the ECB and the Bank of England are going to remain relatively steady relative to the US as far as the central bank and where they hold their rates. Down in the lighter blue there, you'll see the Bank of Japan, and they have increased their rates a little bit over the past year, but they were kind of out of sync with the rest of the world in the sense that their rates remained low, and then they're increasing them as they were trying to tamp down inflation, as we looked at it in the previous slide. With that, turn it back over to Chris to look at the bad aspects in the international markets.
Okay, thank you, Brian. So this is a chart from JP Morgan, and the tariffs is the main highlight that we're trying to show here. You see we highlighted in August that 30 billion. If you take your eye to the far left, you have 2025 tariff revenue in the billions. So you start January, February, March, you move on. So 778. The point that we're trying to highlight here is that the revenue generated from tariffs is continuing to grow. So in August, we brought in $30 billion in tariff revenue. That is really, this is meant to be a negotiating tactic to secure more favorable trade terms, which I do genuinely believe that will happen. The byproduct in the meantime is that we're seeing some push through in terms of inflation that I mentioned on the slide earlier. So we feel that it's important to show you exactly what we're generating as a country in terms of tariff revenue. So that 30 billion is an important number we wanted to highlight for you that came in August. Okay, so in terms of securing our tariff trade agreements, this is a slide from Charles Schwab. Our top three trading partners, if you draw your eye to the bottom left, is Mexico, Canada, and China. This slide, Canada and China flip-flopped from last quarter. So Mexico remains our largest trading partner. There was an agreement that is about to end today or tomorrow. There is ongoing negotiations with Mexico. Currently, they're saying for the next few weeks. So that's a very fluid conversation. With Canada, most products with Canada are tariff free. There are a couple specific areas within steel and aluminum and autos. There's not really a conversation around getting to the bottom of that currently with Canada. And China, the business we're doing with China has dropped off significantly. There are some conversations about improving and making an agreement with China, but very clearly that relationship is our approach is having an impact on China. And actually, one of the things we didn't highlight necessarily is that China's inflation is going down, meaning deflation. So their economy is being affected by us in a very meaningful way. So the last component of that, and even a dovetail from China, the possibility is global tension. So the risk remains something with Taiwan, with China. I'm not saying that that's going to happen, but we all know that naturally that's a concern. Even this week, so if you draw your eye to the top right circle, you see opponents to Western democracy, China. And then if you go down to the list, second from the bottom is Venezuela. So as you may know, we now have some ships parked in Trinidad and Tobago, which are putting a stance, and we're putting pressure on Venezuela about what's going on in their country. So global tensions are a concern, and that's just something that we're monitoring. Jay, let me turn it back to you.
Excellent. Thank you, Chris. To summarize the international markets and our thinking today, here are the good components. International is likely to continue to outperform U.S. equities. The Eurozone unemployment rate remains low, and global inflation remains in check. The Bank of England has cut rates since the last time we met for a quarterly update. The bad. Tariff revenue on U.S. imports are growing. No tariff agreement with our three largest trading partners yet, and global tensions, as Chris just articulated, are starting to bubble to the surface. With that, let's pivot and talk about fixed income.
All right, thanks, Jay. So from a fixed income perspective, on the good side, so this is a chart of the U.S. Fed funds rate. So the Fed funds were declined in mid-September by a quarter of a point. This chart here shows on the dotted lines shows a projected path of Fed funds rate expectations. The purple dots reflect the view as of January, and then the blue dots represent the new expectations. And as you can see there, it's on a declining path as of the end of September. As Chris highlighted earlier in the U.S. bad part, we've got increasing inflation, slightly increasing inflation over the last several months and time periods. And however, we also have the slowing employment growth. So not necessarily the number of jobs, but the growth in the number of jobs markets. So that's the balancing act that the Fed is doing. And actually the Fed, we'll have another Fed meeting announcement here at 1 p.m. Central Time in about 40 minutes. So they'll announce their next move, whether they will remain steady, cut, or it won't be an increase, but it'll more be a stay steady or cut. So if they do cut either this meeting or the last meeting in December, they will probably point to a greater concern of slowing employment growth. However, they may only cut once more this year, because we've got the elevated inflation factor. So they've got two factors that are kind of pulling and pushing at any future cut. So we'll see what they decide today, and then what may happen in the last meeting this year, and then on to the first quarter of next year. Along with those Fed rate cuts, I want to kind of draw your attention to the darker lines in blue, which represent a 1% fall in the funds rate. So as indicated, as you can see here on all these, on the left-hand side, these are all the various type of fixed income instruments. In all cases, or most cases, shall I say, the dark blue line is greater. So that's one of the things, and we'll see here, as you can look at, like, for example, 2-year at the top, 2-year, 5-year treasuries, 10-year, 30 years. So you see the longer the duration, the greater the total return expectations are of a 1% fall in Fed funds rate. So this is how those play together, and we'll come back to this a little bit later in the presentation. So now that we looked at the good, we'll turn back over to the not so good side.
Mhm. So because interest rates have risen over the last several years, and the reason for that policy and that approach is to tamp down inflation, the byproduct of that is that as a country where we're borrowing, if you draw your eye to the top right, we spend as a deficit. So our deficit spending this year is just under $1.9 billion. That's 27% of our budget. If you draw your eye to the top left, just above that orange rectangle, you'll see our total federal budget for this year is $7 trillion. Okay, so now if you draw your eye all the way down to the bottom, and it says net interest. So I call this the mortgage. Like, what is the mortgage? What does it cost us to run the government? How much do we need to pay? Well, our mortgage is $952 billion, or 14% interest. That's the interest we need to pay on these notes, on these bonds that we're issuing. As interest rates decline, as Brian highlighted, this percentage will naturally come down because we have the ability to refinance as a result. But the reality is that we spend more than we bring in, and as a result, with higher interest rates, it exacerbates our deficit spending because our net interest is higher. Okay, and so the next component that's important for you to be aware of is how is our deficit spending? How should you be thinking about the deficit spending long term? And so if you come down to the bottom right chart, this from JP Morgan, it shows you that our deficit spending is larger than our growth component. So this trend is likely going to continue up and to the right. Currently, our total debt to our total economy, gross domestic production, is about equal. It's about 100%. And so that's expected to rise up to just under 116, 117% in the next 9 years. There are other countries that have larger debt to GDP ratios than this, but it still is a concern that we continue to spend. And if we look at the chart on the top right, what you'll see is the forecasted percentage of spending. So if you look on to the right here, I'm cueing you where to go. Our trend is about 5%. So if you see we have a run rate of 5% of the overall debt, and our growth is 2%, well, we're going to add roughly 3% per year to that overall deficit. So deficit spending is a concern, specifically when interest rates are higher. And so this is something that we'll continue to monitor.
All right, thank you, Chris. To recap the fixed income markets, here's the team's thinking today. On the good side, the US Federal Reserve will cut rates by 25 basis points since our last update. They will probably do it again today. Declining interest rates will increase bond values. On the bad side, high interest rates are exacerbating deficit spending costs, as Chris just articulated. So we got to stay tuned because the meeting today will provide us a little bit more guidance for our next call. With that, let's go and pivot into how we're going to apply this on your behalf. Brian, take it away.
All right, so this is kind of made a reference to this earlier before. So as highlighted in some of the video emails that everyone has received, one of the things that we've done this quarter with the decreasing Fed funds rate and the prospects of it declining further, possibly today and more so into 2026. You'll bring your attention over to the left-hand side. So there's an inverse relationship between interest rates and bond prices. So as kind of inverse to what's shown here, as interest rates are decreasing, the bond prices, the bond values will be going up. And then likewise, or similar to this on the right side to what we looked at before on the fixed income options chart, the longer the duration, if that short side of the seesaw on the left goes down, the longer duration of the particular bonds, whether it's 1, 2, 3, 5, 10 years, it'll rise proportionally higher the longer the duration. So one of the things that we did recently as part of the rebalancing process is we actually increased the duration of the fixed income portion of your all's portfolios. So to take advantage of the fact that we anticipated that there'll be potentially a cut today, and then furthermore be some cuts either at the end of the year or going into 2026. We want to take advantage of that and maximize the total return on the fixed income components within your all's portfolio.
Excellent. All right. Well, I'll jump in here and leave you with a couple of slides in terms of the food for thought category. So one of the questions that we've been getting over the last weeks and months is, when is the other shoe going to drop? And so if you draw your eye to the top right, this is a chart from JP Morgan. And this first line item says the number of all-time highs since the start of this year, it's 28. We made a note that at the time we had our last presentation in July, the number was 16. So we continue to hit all-time highs. And then if you go to the third line there, the percentage of the all-time highs that act as the market floor is 30%. So we have a ratchet system here in a sense. So even if your mindset is, when is the next shoe going to drop? It's important for you to know that we're 30% of the time, you're going to be reaching new highs. So it's not as if you need to systematically worry about the risk in your portfolio because we have this ratchet system in a sense. The next thing we wanted to highlight is the price of gold. And if you look at the top right, the annualized returns of stock versus gold, you see that long-term stocks outperform gold. So that portion of your growth portfolio, is intact. The price of gold has really grown tremendously this year. Gold is typically a fear-based asset, and it's also a commodity. So with commodities, prices go up and down. And it's not typically what's called correlated. So if I were to unpack what correlation means, is typically if you have the S&P 500 and a government bond, they are what's called negatively correlated, meaning if equities go down, bond values rise out of fear, out of a response. So for example, there is no specific correlation between gold and stocks per se, it's typically a reaction. It's more a fear-based asset. So we're aware of this. We want you to know that we are aware of the price of gold, of course. So if you feel strongly about gold, you can let us know and we can talk about that. But it's important for you to know that the equity portion of your portfolio continues to outpace gold long term. Okay, and so this is our last chart. We'll put another plug for your Q&A. So whatever questions you may have as we're going through here, please put that in the Q&A, so we're able to address that. This is a slide from Fidelity. So if you're looking at the top, you have the cycle of the economy, early, mid, late, and then into a recession. If you look at the late economic cycle and draw your eye down into green, you see here in the US, we're in the late cycle of our economic cycle. The UK and Brazil a little bit further ahead. Now we come over to the other side. China and well, you see the Eurozone, they're coming out of their recession. One of the other positives about international and why we've tilted towards that is because they're having stimulative government response. They're spending more money in Europe to spur and grow their economy. And you see Japan there. So Japan is doing quite well. They were dealing with inflation, which is why they were rising interest rates as Brian highlighted in that section. So they're in a different place. So it's again, this is why we host this event, is to show you where the globe is and what's positive about it and what concerns, what legitimate concerns we should have. So with that, Jay, let me turn it back over to you.
Thank you, Chris. Thank you, Brian. If you have any questions, please head on over into the chat and pose it to the team. We did not receive any during the presentation. I would like to pose one to the team that I know we discussed earlier, you guys have been getting from clients here recently. And it's around, and Chris, you touched on it a little bit, the polarization in this country and how that impacts decision-making in a portfolio construction process. Chris, how are you approaching the polarization in this country?
So it is, Jay, you hit the nail on the head, which is within our client meetings, it'll be thematically, okay, how is the economy doing really? And when is the other shoe going to drop? And another sort of feeling that things are going really, really well and that this trend will continue. And the reality is that both feelings and both thoughts are fair, because as you see what we presented, there's a lot of very positive components to the economy, and there are some fair concerns to be aware of. So what's really important as it relates to each person, and I guess a small plug for our company, is to focus on your financial plan and to focus on your goals. And if you have a good, clear idea of what your goals are, you're able to filter through any concerns you might have, and also make sure you're not over exuberant, for example, which is a term from Fed Chairman Alan Greenspan. So I do not think that we're overly exuberant, and we're also not overly concerned. And by focusing on your financial plan and asking yourself the question about how you feel about taking risk, you're able to navigate all of the inputs that you're receiving. So we live in a world now where it's almost opinion news. You're getting opinion news from everywhere. We have these things that are sending us thousands and thousands of messages constantly, pay attention to me. And you're like, what am I supposed to do about all this? And so our job is to have, and why we host this event, is to filter through all of that noise, identify the goals that are important to you, and navigate in a way to try to minimize all of these things they're not trying to make us happy. Well, that's for darn sure. They're trying to get our attention through fear. And so that's why we host this. So I guess that, Jay, you're getting my sort of initial reaction to the why behind what we're doing. And so our hope in all this is that you feel confident about your plan and you feel confident about where things are. And if you don't feel confident, let us know. And we can schedule a visit, schedule a time to navigate what you're thinking and feeling, revisit those goals, and make sure that you feel connected to your goals and have the confirmation that you are on track.
Excellent. Always comes back to the plan. Team, we don't have any more questions. That's going to conclude this webinar. Please reach out to the team by email if you do have questions. And as always, you can visit visionbasedplanning.com. Thanks, everybody.
Thanks so much. Bye-bye.